Thank you for watching. This is Glenn Cunningham with GC Asset Management. This is a market brief for Wednesday, February 26th. In today's video, we're going to talk about the recent market volatility and some of the causes. We'll look at coronavirus and economic data. We'll see what the Fed may have to do in upcoming meetings. And we'll finish up by talking about two stocks, so let's get started. In this screen, we can see the major market indexes, the Russell 2000, the S&P 500, the Dow Jones Industrial Average, the NASDAQ Composite, the Dow Jones Transports, and this is the Volatility Index. As we can see, all the indexes are below their 50-day moving average, and several have moved below their 200-day moving average, as much as 10% or more off of their recent highs. So let's look at each one individually. Here's the Russell 2000 down 1.2% on Wednesday, and more than 10% below its high that it set back in August of 2018. The index currently sits below its 200-day moving average. Here's the S&P 500 down nearly 10% off of its recent high of 33.93, but still above its 200-day moving average. Here's the Dow Jones Industrial Average down 0.46% today and nearly 10% below its high of 29,568 set in February. It too is below its 200-day moving average. Here's the NASDAQ. It was up 0.17% today, but it's nearly 10% below its recent high of 98.38. Below its 50-day moving average, but still above its 200-day moving average. Here's the Dow Jones Transports down 2.19% on Wednesday. The Dow Jones Transport is composed of companies that move people and things, such as airlines, trucking, trains, delivery services, rental vehicles, and shipping. It's down nearly 15% from its high that it set back in September of 2018, and it's about 6% below the 200-day moving average. This index, I've found, has typically led the other indexes lower in major market declines back in 2000 and 2008. Last, we have the Volatility Index, or the VIX, which is also known as the Fear Index. This is an expectation of 30-day forward volatility for the S&P 500 based on its index options. It's kind of a good measure of market risk and investor sentiment. You can see it's up off of recent lows of 12.3. Yesterday it was up at 30 and closed today at 27.56. By way of comparison, in December of 2018, when the markets declined more than 20%, the volatility index climbed as high as 36.2. Let's take a look at what may be causing some of this volatility in the marketplace by talking first about coronavirus and then also about economic data. In talking about the coronavirus, let's start first with looking at the current data on how many cases we have. There's 48,268 cases with 2,771 deaths, which is about 8%. You can see the growth of cases from January 22nd through to Tuesday, February 25th. In this chart, active cases actually looks like it may be on the decline, as this is a chart of removing deaths and recovery from total cases to get currently infected cases or active cases. Here's a chart of distribution of cases outside of mainland China, with South Korea having the second most, Italy, Japan, Iran, and some other countries, including 60 cases in the United States. This is a good article from the LA Times. It does a comprehensive review of businesses and industries that can be affected by the coronavirus. I won't read it to you, but here's the link if you'd like to look it up and have a read yourself. What we'll do is scroll through quickly and look at some of the leading topics. The article discusses Chinese factories, cargo ships, visitors coming to Los Angeles, discusses potential problems that Walmart and Target could see, difficulty in getting raw materials, production delays. Apple has warned investors. Facebook, Amazon, and Qualcomm all have expressed that there's going to be disruption to their business as a result of this. Manufacturers are going to be losing production capacity. Supply chains, especially in the ports of Los Angeles and Long Beach, is expecting a 20% drop in activity from a year ago. Casino owners, such as Wynn Resorts, Las Vegas Sands, and MGM Resorts, with their resorts in Macau, will be affected. Americans cutting back travel to Southeast Asia and around the world. Firms that sell goods and service in China affected as well, such as McDonald's, Nike, Starbucks. Skechers has given warnings. Walt Disney shut its theme parks. As well, China's booming cinema industry has lost 100% of $1.5 billion in revenue. So in effect, this article talks very well about the global supply chain that's going to be impacted by coronavirus out of China and around the world, and stating that it's probably going to be many weeks before we get a real visibility on what the true effect will be. So understanding that coronavirus truly have an effect on local and global economies, let's take a look at the U.S. economic data and see how strongly we're performing there. When considering U.S. economic data, we know that the economy is doing well according to low unemployment rates, inflation being relatively low, and the housing market being strong due to growth in prices and also low mortgage rates. But let's take a look at S&P 500 earnings and some of the other manufacturing and services data to see what they're showing. Here's a screen showing the S&P 500 earnings by month going back to 2006. 2006, we can see that the earnings climbed up and started to decline before the market decline. And again, we saw that happen in 2015 before there was a 20% decline in the market in 2016. Most recently, the S&P 500 earnings were climbing up until the early part of 2019 when they started to level off and look like they're starting to decline. If you tack on the effects of the coronavirus, this picture may decline a little bit more in the near future. We're going to have to keep an eye on it. Switching to United States manufacturing PMI, you can see here in this chart that the manufacturing PMI fell to 50.8 in February of 2020, down from 51.5 in January, and that's below expectations of 51.5. That's the slowest expansion in factory activity since August, as the output growth was the softest since last July, with firms stating that weak demand conditions and delays in deliveries following the outbreak of coronavirus had dented production. Services PMI dropped to 49.4 in February from 53.4 in the previous month, and well below market expectations of 53. This reading signaled the first decline in business activity since February of 2016, as new business declined the most since the series began in October 2009. And here we look at the United States Composite PMI. It fell to 49.6 in February from 53.3 in the previous month. It's the first month of contraction in the private sector since 2013. Any reading that is above 50 is expected to be expansionary. Anything below 50 is looked at to be recessionary. So with the effects of the coronavirus, there may be a further decline in S&P 500 earnings. In manufacturing production as well as services production, we could see a decline in GDP going forward. As we turn to talking about the bond yields, I want to start by looking at the S&P 500. Market was moving in a choppy fashion until it had that 20% decline from its September 2018 highs down to the December lows. It then chopped around for most of the year into September of 2019 until at that point the market climbed about 14% into January. This is a very interesting period of time because some important things happened in the yield curve in September of 2019, and also the Fed began its repo operations. Let's touch on the repo operations for just a minute so you can see what that effect was. So I've brought up this recent balance sheet trends from federalreserve.gov, and you can see in March of 2018 how the Fed was reducing its balance sheet until in September of 2019, the Fed started its repo operations, which injected $400 billion into the market. And notice this time period from September until January and February of this year, when they were injecting money into the system, what happened with the markets? So we're back here on the chart of the S&P 500. What happened with the Fed repo operations, that's when they began, and the market moved up almost 14% from September to January of this year before the market started to pull back. What's interesting too is that in the January 29th Fed Open Market Committee press conference, they announced that they would be reducing repo operations in 2019, that they would continue them out to April, but reducing them. And then on February 13th, the Fed announced that they were going to start reducing operations by $20 billion. And the market started to get volatile at that point as well. So there's a lot of things that were happening here in September and early in February of this year regarding yield curves and the repo operation. So let's take a look at bond yields and what they were doing during this period when the Fed was reducing the balance sheet and then began the repo operations. Now here's a chart of the TNX, which is the 10-year Treasury Yield Index, and what it is expressing is the yield on the 10-year Treasury as a number. And up here you can see it was at a high in October of 2018, and this number is actually read 3.248. It's expressed as 32.48, but the yield was 3.248 on the 10-year Treasury. And even through 2019, money was moving into bonds until the Fed began repo operations, and there was also trade optimism. What's important to note here as well is that the 10-year Treasury yield set a historic low here at 1.30 on Wednesday's close, and the last time that the yield was at an all-time low was on, or at a low in 2019 was on September 3rd. And you'll see that's an important date when we look at the yield curves. The low back then was 1.45. So let's take a look at the 30-year Treasury and see what it did during the same period of time. Here is the chart, the TYX. This is the 30-year Treasury Index, and you can see it's a similar chart to the 10-year Treasury Index in that the high was 3.45 in October of 2018. It came down to an all-time low September 4th of 2019, down at 1.91, and made an all-time low here 1.79 on Wednesday, February 26th. So here we have the Treasury yield curve and three curves on the graph. We have the red line, which is September 4th of 2019. That's the period of time when yields hit their low that we were just looking at. Then in December 31st of 2019, when the Fed had lowered interest rates. And then finally the black line, which is Wednesday's closing Treasury yields. And you can see that it's looking very similar. The current yield curve is looking very similar to September 4th of 2019, when there were yield curve inversion scares and the Fed went on its process of reducing interest rates and also started the repo operations to keep overnight lending rates stable. So this is important in that money is moving into bonds and moving out of risk assets as it's pushing the yield curve lower, and it may force the Fed's hand as the short end of the yield curve sitting up here at 1.59 may have to come lower in the near future. What we're seeing on this chart is the Fed Fund futures countdown for the FOMC meetings. The middle chart here shows the meeting probabilities for each of the Fed meetings coming up in 2020. Looking at the March 18th meeting date, it looks like there's a 63% probability that they will keep the Fed funds rate at 1.75%. Now, when you look at the April 29th meeting date, it looks like the probability has risen to 52% that the Fed will cut rates to 1.5% at that meeting. And that would make sense that they would make a cut in the near future, whether it's March or April, to bring this short end of the yield curve down to try to normalize this rate curve, this yield curve a little bit more. So looking at the history of the Fed funds rate, I plotted the Fed funds rate back to 1999 and into the dot-com crash, and you can see there, as well as in 2006 and 2008 financial crisis, and then most recently in 2018 and into 2019, you can see what the Fed fund rates have been. I find this interesting to look at the rise in rates and the decline in rates as the stock markets are declining after the Fed has raised rates. So all this is very interesting, and when you add in the situation with coronavirus, there's potentially some big effects coming on the market in the near future that we'll have to keep an eye on. What I find interesting here is that if the markets do go through a major decline and the Fed does have to lower rates aggressively, considering that rates are right now at 1.75% and expected to be lowered to 1.5% in April potentially, they don't have a tremendous amount of room to go if markets go through a major market decline. Said I wanted to mention two stocks, and this is one of them, ATVI, which purchased back in May of 2019 at $43.76 per share after it had gone through a significant decline, and price increased through 2020 and closed the gap at $63, followed it up, and we had a sell stop and exited at $61.15 for a 39% profit in 268 days. So we're pleased with that one. The second stock I want to mention is Gilead, G-I-L-D, Gilead Sciences, that picked up on Tuesday, February 25th at $70 per share. The reason to get this stock is that it is being looked at as one of the leading candidates for its drug that could treat the coronavirus disease. Since buying the stock at $70 per share on Tuesday, it's up today 6.56%, closing at $74.70 per share. I also like it because it has a 3.64% annual dividend yield. You can see here after the close, the stock shot up to $78.87. That's because it is in phase 3 studies of its drug treatment for coronavirus. So that's good news, and we hope for better news for Gilead going forward. With markets in their current oversold condition, we may expect a bounce in the coming days, but I would expect more volatility until the coronavirus is contained. We'll keep an eye on economic data and watch for the results of the Fed meetings on March 18th and April 29th. We'll be sure to protect capital with sell stops. And of course, we'll be looking for opportunities. That'll do it for today's video. Stay tuned for more in the near future. Thanks again for watching, and please reach out if you have any feedback or questions. Thanks very much. Bye-bye.